very much happy that more than 75 academicians and industry representatives from the length and breadth of India and outside India is participating in this one-week National Faculty Development Program organized by the Department of Commerce, Bishop Moore College, Mavelikara, in association with Kerala State Higher Education Council. I hope that the technical sessions in this faculty development program is highly helpful for all the participants and all those who watch this video to enrich their knowledge, skills in the area of financial market. Thank you.
Hearty welcome to the Department of Commerce, Bishop Moore College, Mavelikara. I congratulate each of you for choosing our department for the week-long faculty development program on financial market teaching and research perspectives, which we organized to bring together academicians and industry representatives as a part of our financial literacy mission, which was started in 2010 in the department to popularize and educate public on financial matters. The department, while organizing this program, has set two specific objectives. First is to accustom the participants on changes to be conveyed to the students and the community. The second is to give research perspectives to those who are intending to do research in financial market. As you know, financial market services, process and infrastructure and market mechanism are changing day by day, and there are a lot of innovations in these areas, and it is the teacher who has to bring the fruits of these innovations to the society. We aim by organizing this program that teachers joined here will do it for the society.
Dear colleagues and dear participants, I am extremely happy to understand that the Department of Commerce is organizing a faculty development program under the theme Financial Market Teaching and Research Perspectives. The theme is very apt to the moment, and I personally believe that this is going to enrich the teaching faculty and all the participants attending this faculty development program. I congratulate the Department of Commerce and all the participants, and I wish that this program is going to be a success and a blessing to each and every one of you. Thank you.
Principal Dr. Gabriel, sir, who is the inspiration behind all our deeds. Vice Principal Animatis Madam, coordinators Dr. Ashish Varghese, Dr. Argisani Kurian, Mr. Rahul J. Kurivula, my dear fellow faculty members from various institutions, dear participants from various colleges and universities. I am very pleased to welcome all of you to this program. First, I congratulate you for choosing Bishop Moore College for an FDP, that is half a refresher. Though we are required to air only 6 sessions, we have added 7 more to make it more comprehensive. Today, I am extremely pleased and also take it as a privilege to introduce a great, passionate and inspiring professor of commerce in the University of Kerala, Dr. Gabriel Simon Thattil. He is the pride of our state of Kerala, in the sense he represents our state by many talks in education institutions across India, and even in the latest Swayam, the Indian MOOC, when it released its first refresher course in financial markets. He is very familiar to the teaching community, especially members of the commerce faculty, but considering his sincere cooperation to our department, I cannot refrain from introducing him a little more. a lot we have to understand about him, who is now working as the director of the Internal Quality Assurance Cell of the University of Kerala and director Center for Tourism Studies of the university. He has produced around 29 PhDs to date. If you go back to his school education, that was spread in several states like Maharashtra, Karnataka, Orissa, and Kerala. He graduated from MG University, also took the masters from there, MPhil from Kerala University with a grade, PhD from the University of Calicut in 1996. He also has one MBA. He qualified the UGC JRF in 1992. Professor Gabriel Simon has been teaching since 1991, who joined as a lecturer and now turned to be a professor since 2010. He has worked in four different colleges and the management institutes of repute in Pune before joining the University of Kerala in 1998. Having a teaching career of more than 28 years on programs like BCom, MCom, MPhil, and PhD. He is the author of 3 books and numerous publications to his credit. He has acted as chief and chair as well as invited speaker in several national international seminars organized by the university. Gabriel Simon Thattil has produced 44 MPhil projects and acted as the project coordinator of 2 major research projects of the Department of Commerce and was the coordinator of SAP UGC project. And he executed a major consultancy work with the Federal Bank on behalf of the university. He has acted as the department coordinator for their extension programs as well. Linkage programs, that is the extension services to the community, which is specialized in institutions like IITM. He was also the coordinator for the 3 international seminars and acting as the organizing secretary for All India Accounting Conference. Currently, he is the governing board member of the CDS, Central for Development Studies, Thiruvananthapuram, and chief editor of Indian Journal of Accounting, which is the formal journal of the Indian Accounting Association, and which has 53 branches across the country. We are fortunate that we all could meet him on Google Meet. I stop my words by welcoming him to this function and all of you to this program.
Thank you for this opportunity. First of all, I thank Bishop Moore College for your initiative for taking up a workshop of this kind, and that too as a faculty development program. And I think it is in association with the Higher Education Council. Now, this theme is financial markets. And there are lots and lots of things, I think, which we need to, as teachers and researchers in commerce, we need to understand as far as the financial market is concerned. I'm sorry I was a bit late because I was tied up with an interview, and that was also online, and there was some technical issues in that. Now, let me start by making a firm assertion to the fact that what we actually learned and understood about the financial market and its constitution and base as it was years back and as it is today is quite different. Now, conventionally, when we talk about financial market, we have learned, that is how I learned, and even in literature or theory as it is today, we see it divided into money market and the capital market. We say that the money market is for short-term funds and the capital market is for long-term funds. Again, we are talking about money market players being commercial banks and capital market being the stock exchanges, where again you have a segment, the primary market, which is IPO, and the secondary market, stock exchanges play a role there. Look at the market, some important issues which come up. Number one is the market getting highly integrated. Today, you look at any institution in the market, suppose you say State Bank of India or ICICI, it is not just stock exchanges that help you in trading with in the financial market. The market is not segmented in terms of insurance, capital market, mutual fund, venture capital. The same player, suppose I take State Bank of India. State Bank of India has got its own insurance arm, it's got its mutual fund arm. It has participants. You can open demat accounts through them. So the market is becoming highly integrated. And number two, information in the market, because we are going in a demat mode and we are going on an online mode, there is some kind of a efficient market with some kind of information symmetry, because we don't have difference in information in different points of time at different places. Although we are not saying it is perfectly efficient, there are possibilities and potential for it to become information-based efficient. The third important factor is the technology drive that is taking place. If we look at all kinds of products and services that come up in the financial market, it is all technology enabled in a dematerialized form, and it has broken all the limitations of time and space. So we have a situation where your market has got seamless opportunities in terms of products, in terms of services that they render. It is not conventionally the equity that we just thought of or we believed of. We have the equity segment, we have the derivative segment, and we see, although the Bombay Stock Exchange, which is the oldest in Asia, started in 1875. Today, in terms of volume, you have a derivative segment to be very strong and the online segment and the NSE to be more strong. So all kind of fund of funds, the derivative segment, the futures and options are making the market all the way innovative. But at the same time, it does not always, as we see based on the efficient market theory, reflect what is happening in the economy. If you look at the COVID pandemic, what happened in the last maybe 3 months, we saw that there has been a considerable decline in terms of employment, considerable loss in terms of production, the GDP being pegged down considerably. So market efficiency wise, there has been lots and lots of decline. But capital market wise, financial market wise, more specifically the stock exchange indices wise, although there was volatility, the decline was not that significant. So that means the macroeconomic fundamentals at times are not fully getting integrated into the capital market indices as we see it. So there are lots of issues on active trading that is taking place, on sectoral trading that is taking place, on certain emerging industries on which you can have opportunities which are there for growth. So the capital market is moving on that line where you have your straight through processing kind of options. It has got segments for government securities, it has got segments for debt, it has got segments for commodity exchanges, it has got even now new platforms for the MSME segments, which are all yet to get developed. So in spite of all that, we look at the market. It is not absolutely risk-free. It is not absolutely free from all insider trading, but it has opportunities if you look at it in terms of investment. But the understanding of this market, the understanding of the varied kind of products and services that exist in the same, and the understanding of the way we operate through it, that is the most important thing, because you hold physical assets, the time span through which we acquire, let it be land or gold, or the time span through which we liquidate is generally longer. But this, with a very small investment, very quick acquisition and very quick liquidation is possible. And at the same time, the amount of risk and volatility has to be gauged. And you have a host of portfolio-based mutual funds and derivative instruments where your risk can get diversified. So understanding the market in its holistic terms, understanding markets based on the pillars of investment. Normally, we take market products and services on the basis of return alone. But the pillars of investment are, in fact, liquidity, safety, return, and risk. So it's not just return, that somebody offers some return, you immediately jump into that return and say it is good and you go. We need to look at the risk involved, the safety elements, and liquidity. So understanding the financial market requires understanding of a lot of information that comes from the offer document, that comes from the IPO segments that are there into it. So we need to have a good look at all these aspects, understand the modus operandi, and then come to it. So this is where the market offers immense potential, and this is where the market has its own risky elements that go into it. We also need to understand, as far more significantly for India, the behavioral finance segment offers in our financial market in a big way, where biases are there, where we go just by what others say or what we hear from others, the herd mentality, the heuristics, and so on. So I'm happy that you are looking at a workshop of this kind. I'll be back with one session on an element of it. And we have a host of resource person who have been lined up for different aspects of the financial market in terms of the systems that are there, in terms of the operations that are there, in terms of the trading procedures that are there, and obviously in terms of the risk and challenges which it involves. So with the consent of all the organizers, all the participants, with great pleasure, I formally declare this workshop of yours as open. And I wish it a very joyful learning experience, and I hope that you will all gain deeper insights and better understanding of applications of the financial market, and that will help us in not just in understanding the concept, but also transacting it in terms of live cases in our teaching and research experience. I declare this workshop as inaugurated and wish all success for the workshop. Thank you so much. Hello? Hello?
Hello, Simon sir.
Am I audible?
Yes, sir. You can continue on your topic, market structure, sir.
So we are, how much time we have for that?
You have 1 hour and 15 minutes.
So this is a session. Okay. So then I'll move into the structure that we have and the nature of the operation capital market today. Now the structure, already I have given a brief introduction on what is the nature that we have moved into integration. Now what we understand by, I think the structure comes.
Not said. We didn't have such a ceremonial one.
Okay.
Later we enter into the technical session.
Okay, so then I'll move into the structure that we have and the nature of the operations that you have in the capital market today. Now the structure, already I have given a brief introduction on what is the nature that we have moved into integration. Now what we understand by, I think the structure covers the elements of integration, the elements of segmentation, the elements of cross-marketing, and the elements of looking at information barriers being removed. The number one aspect is integration. How do you understand how integrated our market structures are? We understand how integrated our market structures are in terms of the differentials which exist in prices. Suppose you compare the market that you have for commodities. We see different prices in different places. And the difference in prices in different places.
Ceremonial one.
Okay. Brief introduction on what is the nature that we have moved into integration. Now what we understand by, I think the structure covers the elements of integration, the elements of segmentation, the elements of cross-marketing, and the elements of looking at information barriers being removed. The number one aspect is integration. How do you understand how integrated our market structures are? We understand how integrated our market structures are in terms of the differentials which exist in prices. Suppose you compare the market that you have for commodities. We see different prices in different places. And the difference in prices in different places is coming because of several reasons. One is the information gap that exists. We do not know about the price in the wholesale market, the retail market in some place, on some other place. Another one is the movement. The goods move from different places, so transportation issues. Yet another issue is convenience. Now, when you look at the capital market, these factors do not exist there. You do online trading, and the methodology through which the structure has changed, it has brought in a lot of integration. Years back, when we talk about the capital market, we had a system where we followed the outcry mode in the capital market. So if somebody wanted to buy or sell shares, the person has to virtually go to a stock exchange. They have to find a broker, entrust the purchase or sale to the broker, and that broker enters the particular trading hall, and inside that you have an outcry mode. That means it's just like a fish market or a vegetable market where you make where you continuously involve in giving the price out, crying out with the price. And once, suppose I want to sell the shares of a particular company, say ACC, I go on ACC with the price, crying ACC with the price. Somebody wants to buy, will come to me, and both of us will go to counter, which is represented by ACC comes back. And there, what we do is we sign the contract note, then this goes to the company. You have to surrender your share certificate. You have to enter the transfer register, then the register of the earlier place. Transferor's name has to be removed. Transferee's name has to be included. It has to be sent back. So it is something like 3 to 4 weeks when the share certificate is taken back and a new share certificate is issued. Today we have it in a DMAT form where we do it online. There is no specific trading time like 3:30 to 5 as it was earlier. It starts from 9:30. All the prices are available on screen, and all the markets that you have, with your DMAT account, you trade. So this is where the integration has come, and that integration has brought in significant impact on the capital market. Number two, in the structural change that has taken place is the relationship between segments of the market, which I put in what I thought was the inaugural address. The segments earlier was that there was very little of movement in structure which took place between the different segments of the market. Say, for instance, mutual fund was one segment, insurance was another segment. Even in banking, we had agriculture banks, Exim banks, and all. But today in insurance, there are lots of products which are based on capital market, which are based on the net asset value, which are based on equity and the mutual fund products. So there is a lot of movement that takes place. Although there are segments, even now we say mutual funds, we say insurance, that segmentation has slowly lost its basic relevance, and we are moving into that integrated part. Mentioning in terms of information was the fact that barriers of time and place are immaterial. That has happened in almost all e-finance, and that is where the structural change in the market has taken place. There is no physical space or place where you go to trade. Not just in capital market, in all the elements of the financial market, be it banking or insurance or mutual fund. Earlier, it was like it opens at 10 o'clock, closes at 5 o'clock. You would go there and deposit. Here now it is anywhere, anytime. Even in the capital market, although the trading takes place at a particular time, you can place orders right from your system at any time. So anytime, anywhere system is a structure which has taken over in the market. That structure has come to stay as far as the market is concerned. And the structural change which has taken place in the market as far as trading takes place is what we talk about in terms of the straight-through processing. Now, straight-through processing, it came to India quite towards more than around 15 years back. We have a technology backup system where your front office, the middle office, and the back office gets integrated. That means, again, you're linking between your bank account, your DMAT account, and your accounts in terms of insurance and other services. So suppose I place an order in my account, in my DMAT account. The front office will take it for verification to the back office. My bank account will be verified. The cash presence is taken into account, and then it comes back. And if you have cash and if the order is within your limits, then you get the product. Otherwise, you are not going to get the product. So this is all taking place through one source, the front, middle, and the back office, whether you get the order or whether you do not get the order. So this is yet another change which has taken place. Now, when this integration, when the segmentation is lost, this integration takes place and the information part happens, what actually is happening is a fact that we are moving into a system where the good big exchanges itself alone has relevance. Structures of other, because most of the securities which are in the A category or which will constitute, say, BSE 100, 200, they all get listed in NSE and BSE. So the other, and everybody from any place can trade in NSE or BSE. So local exchanges which are, does not have the same relevance which it had earlier. So this is yet another change which is taking place. Now, the structural change that has taken place, again, as far as the market is concerned, is our understanding of the nature of investment that is happening and the speculation that is taking place. Now, as far as markets are concerned, we have these two philosophies, investment and speculation. Now, what is our understanding of this? We normally say investment is long-term and it is less risky, speculation is short-term and it is more risky. But the market structure is such that we need investors and we need speculators. It should not be completely driven by investment alone, where hedging cannot take place, and it should not be entirely driven by speculative elements alone. Then you have just extreme volatility and price rise. Now, what do you mean by investment? By investment, what we are trying to look at, we are trying to see whether you take hold of an asset, you take delivery of what you are buying, keep it with you, pay the price, and hold it until you achieve the objective. That is investment. Whether it is a share or it is land or gold or whatever big asset. I purchase it, I take delivery and hold it until I meet my objective. If I meet my objective in 1 week, I might sell it after 1 week. If I meet my objective after 6 months or 1 year, I will keep it up to that time. That is why we say it is less risky and it is long term. Because I have paid the price and I am going to again do the reselling back only when I have achieved my objective. But in speculation, there is no taking delivery. It is short term. That means I buy something without taking delivery. Now, how is it possible to buy without taking delivery? That means I am buying in your capital market structure, you have T+2. I am buying with an intention to sell it within the short span, the T+2, to somebody at a higher price. So I have no intention to take delivery. I will never take delivery. I'll buy for a price and I'll keep within that time another party to whom I'm going to transfer at a higher price. So this is risky because maybe within that time, if price falls, I might have to sell it off at a lower price. Similarly, I will sell without having something with me. I'll enter into an agreement to sell, and within the time the sale has to take place, I'll buy it at a lower price. So this is speculation. Now, the operations of these two have to be kept in balance. The major players in our capital market structure are institutional. We have institutional investors. We also have individual investors. Institutional investors, again, you have your foreign institutional investors and the Indian institutional investors, which are generally merchant bankers, insurance companies, mutual funds, banks and all. And your individual investors are retail investors and high net worth investors. But the combination of the structure of our market is such that it is more driven by institutional investors and the amount of individual investor participation is relatively less. So those small, if you have from all the states across a good presence of individual investors in the market who can control the market, who can regulate the market, who can take advantage of the changes that take place in the market, the market is likely to be more robust because we have a good place for investors. And one of the functions or one of the structural changes that the market is now trying to accommodate, it is trying to give more space for savings. But then we are trying to make those savings, or we're trying to make those aspects of investment more driven by knowledge-based investment. So that is why we have SEBI, the regulator for the capital market, as well as IRDA, which is a regulator for the insurance segment, both of them looking very specifically into the knowledge part of it. And the key knowledge part of it is what I said earlier, creating a market structure for the capital market where you have all these elements balanced. If you look at your right from Markowitz theory on mutual funds, we are talking about risk-return balance. Our investment talks about risk, return, safety, liquidity balance. So that is why SEBI puts lots of emphasis on having greater inclusion in your market structure, having greater financial literacy in the market structure, and having a greater element of what we call investor knowledge. And this knowledge-based investment is based on this. So this is the change that has happened in the market structure. Now, what I would like to put at here again, along with the market structure, is we have theories which talk about efficient market hypothesis, where we are saying the market is very efficient. And this efficient market hypothesis is what is often seen as the structure for the market. But efficient market hypothesis works under a set of assumptions. So let us understand that. Those assumptions include the fact that the market is efficient in terms of rational investors. Number two, there is information symmetry. There is no information asymmetry. And in terms of systems that operate, we have got good systems in place. Now, when you look at the movement in the indices, we don't see this always happening in that form. And that is the reason why we have the behavioral finance issues. Because rationality means always acting on the basis of reason. So you make your fundamental analysis, you make your technical analysis, you look at the CAPM models, and then you decide, so why should I invest, where should I invest, how much I should invest, when I should invest. And the market structures are created on that line. If you look at any offer document for the shares which are offered under IPO, or if you look at the insurance information that comes, there is tons and tons of information and safety measures which are given there. But our mechanisms are not always structured in a way in which we take advantage of that. So when we look at market structures for that matter, we are understanding it only in part. Say, I'll just give one or two examples. We talk about risk aversion in the capital market. And this risk aversion in the capital market generally happens because we believe that equity is very risky, share is very risky and volatile, and it is true to some extent. But the market still is organized. This market with its structure is still having its own regulators in place. When we say risk aversion, understand that in the same state you have private money lenders operating where there are no regulators, where there is no organized market, where they have no organized systems. We have private chitties, I'm not talking about the government element, the private chitties which again follow the same route. So there are totally absence of structure. And there are people who go and make their investments on that part also. So let us understand the capital market structure in terms of money, in terms of capital market, in terms of IPO, and look at the factors which contribute to the volatility. Understand the risk appetite that you have. It is not that you should always go for all the varied products. Maybe my appetite accommodates only debentures, or my appetite accommodates only debt, or my appetite accommodates only government securities. So you can do that. And there is also scope for small kind of savings, which when it grows, the principal part is kept safe and the interest part is moved into a more risky, volatile kind of thing. So we have a momentum strategy for that, when we have a contrarian strategy on that which is of high risk. So these elements which do exist in the market, these systems which do exist in the market, they have their own play in it. Now, in that, as I said earlier, when we say debt and equity, that is one part of it. And under that, we have a very strong derivative segment. We have the futures and the options, which are very strong there. And you have fund of funds. You can invest in indices. You can invest in exchange traded funds. And now even you have, for external commercial, taking advantage of the markets abroad, there are instruments which are talking of ADRs and GDRs which are over there. Now all these are giving us, the options are giving you an option to buy at a price without an obligation to exercise. So you have an option to do it. Now, similarly, in futures, you go for forward trading. But then these segments here are just helping you to hedge. But we need to understand that these structures which are inbuilt into the market can be taken advantage of only when we have our understanding about the factors of risk that are there in it. What factor of it can be controlled and what factor of it can will remain uncontrolled. The systematic part of it and the unsystematic part of it, which is often there over there. So this is the kind of a financial market that we can a part of, which is generally acting as a part of a very broader financial system in which we operate. So the market conditions are of that kind. The structures are built upon this process, and we are continuously what we call looking at enhancing our ability to understand this. But still it remains complex. It remains complex in the sense that this risk return appetite is not very often understood in terms of trade-off. That means I cannot have a very high expectation of return without taking a related risk into that. And many of our parameters of the sub-markets in the financial market have subsequently changed. So example, even in banking for that matter, earlier our concept was intermediation. That means we learned conventionally that banks are intermediaries between those who save and those who need loans. So all those who deposit will go to the banks and all those who want to take loans will come to the banks. But disintermediation process is like the big industrial loans. Instead of going to the banks, they are looking at an IPO route at times. And banks are then more concentrating on retail finance. Again, there is a concept which says preponement of consumption. Earlier, our concept in the market was postponement of consumption, which again means that you save and along with your savings, you add some money and you buy a product. So you save and consume. And today, the banking concept is you take loans and consume. So your savings is to repay the loan, not to buy an asset. So the components and systems are changing, and that is why we are having a huge consolidation that is taking place in the banking system, because we are investing in technology. We are trying to have integrated market, all kinds of products and services. So you cannot think of a bank which does not have all internet, e-banking facilities, RTGS, NEFT, and all these technology base which is there for the structure of the market. You have to invest in all of them, and when you have to invest in all of them, obviously you have to have a wide clientele. Because suppose, why is this internet banking or all your even in insurance or in capital market, your demat account, is all talking about transferring funds from one place to another, transferring funds from product to another product, shifting or swiping your mutual fund products from one to another. So if this has to happen, you need clients across. If you have a limited number of clients in only one location, then there is no meaning in having a huge investment in all this technology. So today, when you are having this investment in all these what you call supportive technologies, obviously the need of the market is a wide clientele that you have to build up across. And perhaps we are thinking of financial supermarkets on that context. So the structure is changing, where your fundamentals of the economy is going to get integrated into a number of ways. And again, when you're saying liberalize and try to make free loans available to different segments, including your MSME segments based on the post-COVID pandemic, there again, there are issues like if you give that free lending, where is this money going to come up? What is the NPA structure that we have? But still we have regulations in place, not that it is free from all kind of scams. Still there can be scams, there can be insider trading, but we have some reasonable good regulations for financial market in place where these factors can be taken into account. Now, looking at the structure, one important aspect, or perhaps one or two important aspects with which I'll close, is we need to have greater amount of inclusion. If you look at the penetration that you have in insurance, if you look at the penetration that you have for individual investors in the capital market, perhaps apart from banking, in terms of bank accounts, it might be good. The penetration, we need to enhance that. And we need to understand the concept of sustainability, which is very important in market structures. Sustainability is simply looking at a concept where you are saying that systems are all interrelated. And this is very much true with financial market structures. There is a very strong linkage between banks and non-banking financial institutions. There is a strong linkage between insurance and capital market, mutual funds and the capital market. So they're all cross-linked in terms of systems, and we need to sustain the entire financial system. That is why we have financial standards and we have your reserves maintained to keep that protection. Now, what exactly is the system? System talks about, in a very common perspective, it just talks about input, process, output. Any system, I'm not just talking about the financial market, any market or any product system has got these three things. Input given, some process is undertaken, and an output is given. Even education, for that matter, is a system. We take students and teachers, we teach them, and you give out graduates, postgraduates. But the success of a system will depend upon what is going to happen with the output. That means that depends on how the output is going to become part of the input of another system. So if you create graduates, they must get observed in the industry, or they must become entrepreneurs, or they must become employable. So that next system must observe them. Now, exactly a replica of this, or exactly a system similar to this, is what we see in the financial market. I don't know whether you will remember, a few months back, RBI brought in some regulations regarding gold loans. Non-banking financial companies across the country were advertising gold loans in a very big way, saying that it will be sanctioned in 2 minutes. The ads were coming showing that time across the counter you get money. And there is an economic concept which talks about loan to value. The loan to value which non-banking financial companies were giving was almost 95%. That means if you keep gold worth rupees 1 lakh as security, you get a gold loan of 95,000 rupees. Now this is highly risky, because economic concept or theory will tell us that normally it is 75, should not go beyond 75, 80%. Now when these people are giving 95%, banks were giving 75, 80%. So the demand for gold loans from banks were very less. Now what happened, or why RBI intervened? When you give 95%, imagine a situation, now continuously the price of gold is going up. Imagine a situation if the price of gold falls. If it falls beyond 5%, then the chance of getting back all the loans that you have given is lost. And the exposure to such loans was a very huge amount among all NBFIs. Now, was this just a problem of NBFIs? Absolutely no. Because these NBFIs were sourcing funds from banks. That means if the loss happens, the damage takes place in the NBFI, depositors of bank would lose their money. That is why RBI intervened at that point of time and said the exposure that NBFIs can have with the banks have to be capped or limited. And this happened. Same, you have a link between insurance companies, and there was a time when IPOs were given, and some of the public sector IPOs which did not take off. There were insurance companies of the public sector like LIC asking them to take over the IPO. Now, if that IPO is not successful, the insurance company would have to pay for it. So there are such cross linkages which takes place. You enter into a mutual fund. Mutual fund is selecting products and they are managing it in such a way. So what is going to happen in the underlying asset? Because all forms of derivatives, the word derivative itself means that it derives its value from some other assets. So derivatives is based on the underlying assets. Similarly, the cross linkages between these sectors are very, very important. So I cannot say that I have parked all my funds only in banks, so banks alone in the financial system can need to be sustained. Or I have parked my funds only in insurance and I am not bothered about capital. They all have a linkage. That means the entire system has to be, the entire structure of the financial market has to be kept robust and strong. It's not just only one segment that alone can sustain itself. So whenever you hear of an offer, whenever you hear of a new product, whenever we get information about a new service, be it equity, be it debt, be it debentures, be it bonds, or be it any other product for that matter, even when it comes from private money lenders, we have to have a complete understanding of what is this, how is this going to sustain. If somebody tells you that they're going to give you a 25%, 30% interest, you have to first, or we have to first think of how is this going to happen. If this is going to happen by virtue of giving us 30%, we are only looking at the return now. Earlier I mentioned about the pillars. We are looking at the return and we are happy with 30%. But think of what is this man going to do. Now suppose that private money lender is going to lend to somebody. He has taken the fund at 30%. So what rate will he lend? He's putting it to yet another system. So maybe he's lending at 50%. Now, who is that borrower to the next system to which he is giving it? And how is he going to make a profit when he has borrowed at 50% or 60%? So when there is a loss at the other end, that loss will backfire to the money lender and it will backfire to the depositor. So this is sustainability. That means the output of every system must get a place in the input of the next system, depositor to bank, bank to loans, insurance products to the investments that they make. They all need a very perfect, wise understanding of how they get connected and how they are well used. That is why we need regulations in place. We need a very organized market in place, which we have done, but on which we need to have greater level of literacy and inclusion. It's just like to compare financial market with the commodity market. The commodity market has a Consumer Protection Act. Any product that you buy, if you have been deceived in terms of quality or in terms of content or in terms of a decay, you can make a complaint. But how many such complaints come? That is because we are not fully engaged in the literacy part of it. So what I'm trying to bring across is the integration that has taken place, the developments that have taken place, the regulations that have been put in place have all brought the subsystems in the market together. But the same subsystems that you have in the market, the money market, the capital market, the banking system, the IPO, book building process, the capital market, they all have numerous opportunities. They all have potential to give you return with an inherent risk. Now it is up to me to decide how much risk I can take, accordingly anticipate a return, how I can keep watching, keep observing these changes and take advantage of the structural inputs that can come into that. That we call as wise investment. So it's a holistic understanding of the financial system, starting from right the regulator. You have on the top, as far as banks are concerned, the RBI. You have SEBI on the top. For depositories, participants also, you cannot open an account with a depository. We open an account, a demat account with depository participants. maybe like India Bulls, Sheikh Khan, Geojis, all those people. But at the top you have a depository, NSDL for NSE, CDSL for BSE. So we need to understand their role, what financial literacy they are providing, what is the rationality behind this, and only then go for that. We can't have a mad rush for that. And those structures, those segments which are there in the market have been created actually with this intention, or they have been created with this, propensity for that. So in spite of all that we talk about markets, the Indian market still has got potential for that, because even when we had the subprime crisis, we saw many of the foreign markets being closed down, but without a single day of close down, we could still manage. That again, as I said earlier, does not mean that there is no insider trading or everything is perfect. Definitely we have volatilities, we have ups and downs, but much of this ups and downs can be more controlled, can be more regulated, and be made more efficient if we put our minds into a better understanding of the structures, the relatedness, and the sustainability part of it, and also the inclusiveness. We cannot have any segment in an economy left out, because at some time it will backfire to the financial system. That is why even when the COVID pandemic took place, we were looking into possibilities like migrant laborers or getting more and more micro, small, medium enterprises. We want a larger segment to be included, whether it is depositors, investors. We want a larger segment, greater participation. That indicates the robustness of the entire market and the structure that it has. So we are today talking about market structure, financial system, and the structure of the financial market with its integrated, with its cross linkages, with its cross borders, which are the segments which are slightly becoming thinner and greater flow taking place between the subsegments. Looking at all the pillars of investment and taking advantage of a very knowledge-based approach to that. And that is our, precise understanding of what exactly is the financial market. So that it has opportunities, it has challenges. In fact, you cannot always look only at opportunities without challenges. You cannot say that there are only challenges. There will be opportunities also. But your rationality, your capability is something that we have to look into. But the ease with which you can enter, that is in acquisition, and the ease with which you can liquidate, that is exit, is both possible with the kind of structure that you have. So this is what I have to put across in terms of structure, because sorry, I started a bit late and we are a bit late now. If you have something to share or anything to ask on this, you can take this time now. And perhaps in between some of your time, maybe later also, if I get time, maybe I can enter into taking up some of your questions later also. So if you have anything to share on what I have put so far, please do that now.
If anybody has any questions, it's free. The forum is open for you.
You can please unmute your mic and raise the question, or you can put it in the chat box and maybe someone can. Yeah.
Sir, I have a question. Sayyid Ahmed Saad this side. Sir, you talked about the arbitraging. So is it possible in India if I purchase at BSE and sell the same at the NSE? Is it possible in India, sir? Or any other local exchange? Can I do have arbitrage?
We definitely can do that, but the possibility, when you look at your hypothesis, we talk about the process of arbitrage, buying at a place where it is low and selling at a place where it is high. Remember that on your screens with your Demat account, simultaneously the price of the scripts are available to you. So suppose you see at one place 10.2, another place you see it will not have a major change, because if there is a major change, suppose in one place it is 10.2, in another place it is 9.8, immediately you will see lots of orders because there is no need to go to that place. Earlier, that's what I said earlier, price differentials are prevailing because I need to go there. Suppose I'm in Kerala, I'll have to go to Cochin Stock Exchange to do that, or I have to wait for the trading time to take place. Now I'm seeing all these prices simultaneously on the screen. It is screen-based electronic trading. So the chances of having a huge difference is very narrow or very mild. So it is more integrated on that form. But even if there is a small difference, you can see the arbitrage cost. That is, you will see that there will be a lot of buying in 9.8 and selling in 10. And this you will see that it gets equated. So very fast it will move to equilibrium. That is where we are having, because we see this all simultaneously, and I can, from any part of the world, I can do it anytime. So definitely it will work. But the problem is, that's what I said earlier, rationality. In the sense that there was for a short time a 9.8, but I didn't know, or I didn't see, or I was not on the lookout for it. Then you have what we call earlier as information asymmetry, or observing there is a lag between information being given and information being observed. That is why in your efficient market hypothesis and in your all your theories which we talk about in portfolio, we assume rationality. So if rationality is fully taking place, arbitrage will take place. The chances for rationality and the chances for symmetry is greater when you have the screen-based electronic, because once you have logged in, you see all the exchange prices together. I hope I've shed some light on that.
Thank you, sir.
Thank you so much.
Thank you. Does anybody have any other questions?
Yes, I would like to ask one question.
Yeah.
Am I audible?
Yeah, sure.
Yes, I'm Afsir. Could you please give us a larger orientation about the structure of financial markets in India? Because first of all, we want to understand who are the institutions and what are the systems in the money market and capital market, and what are the tools and equipments in which how we can participate in this market, and also if you can give a larger structure, a larger picture.
In each of the segment, I think you have a detailed kind of a session. The broad structure I have already given you. On the top, you have financial systems, which are institutions, instruments, services that are there. Under the, institutions, instruments, services, and markets, 4 components. Under the financial market, you have money market, capital market. Under the money market, you have the main institutions are commercial banks. Under the capital market, you have the primary market, which is in the form of IPO, book building process. And the key element is there you can trade even without a broker in between. And you have the secondary market where stock exchanges are there. The trading takes place there only through brokers. Now, if you're talking about instruments, there are a host of instruments, perhaps starting from debt, equity, futures, options, fund of funds, indices, trading indices, exchange traded funds, mutual funds, and again mutual funds into open-ended, close-ended, capital appreciation, dividend-based. So each has got its own features. And today we also have a system where we can switch before it. I can put one into one, and after some time I have an option to move into another one. So I cannot within a short span talk about all these instruments. This is the broad structure into which the market is put into. But what I was trying to say is, when you say the structure is like this, money market, banking, it is for short term, capital market, long term, and under that IPO. This initial structure, which was very demarcated and segmented, is not that thick as it was earlier. Because earlier, even in banking, we used to have specialized bank for agriculture banks. Banking again structure is divided into agriculture banks. Then for earlier, now we have MSME. Earlier we had SSIs. Then for foreign exchange, Exim banks. So banking itself was again subdivided. And again, you have insurance, which was doing only insurance. They were not into money transfer. They were not into mutual funds and other things like that. Now today, that's why I gave you the example. You take State Bank of India, it is a bank. It has got its own arm on insurance. It has got its own arm on mutual fund. It has got its own arm where they do depository services. So where do you put, you can't 100% attach it only to a bank, because they're doing many functions which are cross-related. And again, it is the same bank which will be perhaps giving you foreign exchange. It will be giving you money transfer facility. It will be allowing you to link yourself to the demat. It will be linking you to your insurance. So the structure that earlier demarcated these things are not very strong. As far as products and services in each, I have not gone into that, the structure of products and services, because it's something where each product, I just gave a list of them, has to be given in detail, because I have to tell you how the process of options goes, futures option goes, which will perhaps each one will take 1 to 2 hours. I think I have shed some light on the basic structure.
Yes, sir. Thank you.
Thank you.
Any other questions? Does anybody have any other questions? Any other questions? Okay, I think Asin Mahmood wants to ask one question.
Yeah, sure.
Asin Mahmood. Asin Mahmood, sir. Asin, sir. I think Asin sir is last. I think Smita Vishanai has a question. She would want to know which is the most affected financial sector player in COVID.
As far as COVID is concerned, we can't directly attribute it as of now. Some of the sectors which are prone to it could be real estate to some extent. It could be those which require physical movement of goods and services. But that is only temporal. We can't put it on a long run. We can't look at its impact. Perhaps medical equipments and health would be in a better position. But as I said earlier, although macroeconomic fundamentals showed some reactions, we didn't see that much reaction in any of the sectors that had. But there were banks which showed loss and banks which showed profit, which results came down. But that has got nothing to do with COVID. As far as COVID impact is concerned, definitely when income comes down, savings will come down, and that way there will be some impact on banks. So you cannot attribute it to any particular segment. It depends upon the supportive system to which it directly relates. Say, for example, tourism and real estate companies, malls which they hold, their income comes down, and that might have, we have not seen it fully happening, but that might have a future impact in terms of such companies which deal in that, the market value of their shares could have an impact, because maybe for 1 year they will see a downturn, and that perhaps will have an impact on that. But then now the neutralization took place, that when it came down, there was some buying into that. People saw that this COVID will be perhaps 6 months, 7 months impact, and after that will go, so it is the right time to buy. So there also there was some balancing, and that's why I said capital market indices did not show a severe downturn. If you look at the entire 3 months, 4 months period, as expected, looking into the basic fundamentals of the economy.
So there's one more question that has come up. That is Sruthia Vayan. She has asked if you could shed some light on the gold price surge post-pandemic.
Pardon, that was once again?
The gold price surge post the COVID pandemic.
Okay. The gold price surge, always you see there's a inverse relationship. Earlier I just told you what is happening with the movement. Basically, COVID shows signs of restricting movements. So that means movement of goods and services is for the time being we are having a problem. So you have a lot of people coming inwards in migration. You are seeing a lot of people losing their jobs as far as employment is concerned. So physical assets in terms of savings, you put your savings in physical assets or in financial assets. So physical assets generally was not seen as something which is very forthcoming. And in terms of financial assets, there was a large segment, as I said earlier, more specifically retail investors who looked at the capital market being risky. So options, physical asset, land, financial assets in terms of these things going down, they looked at gold as an option. So whatever small things you have, put it in gold. And there was not just to a greater extent, there was speculation also. So that was what to this growth that took place. That it is more speculative and the optional part of it that takes place. When you see the greater heights or better things happening in the capital market, you will see some. So this is basically on those speculations.
Question, that is, Indian economy is likely to go down. Can stock market do anything towards this? And that's question from sir. Was it? I could not see him.
Can the price of what go down?
Okay, sir. The Indian economy is fundamentally, I think he has asked Sujitra Devi. Indian economy is sure to go towards a negative growth rate in 2020-21. So do you think the share market can play a crucial role?
Okay. Definitely, because the economy going down is not just India alone. Worldwide, it is COVID-based. You have that impact happening there. But still, there are certain promising hints. That's why we are seeing our market being going up. That's what I said, with some sectors still showing promising signs of growth, some sectors showing deep signs of what you call retardation, like tourism. Still, we have a segment where we can perhaps come back. So what we are now talking about, GDP growth rate moving into negative, is predictions in terms of IMF, which is basically true because employment and things go down. But it is part of a global phenomenon. My expectation is like there will be a recoupment period. And when that recoupment period takes place, investment will automatically spin off, liquidity will go up, and already government has taken some packages to enlarge the MSME segment, and that MSME segment enlargement will create greater spread. Instead of having few big organizations, we are now trying to look at local resources and a larger number of MSMEs, which will perhaps create an improvement in the market.
There is another question. How to restructure our education, teaching and learning, so that the students understand the more practical aspects of the financial market?
One aspect is, as I said earlier, having cases. You look at MBA as well as commerce students in Gujarat and in Maharashtra, you will see that most of them have demat accounts. Now, having demat accounts does not mean that you should speculate or you should do big business. You can even take one security or two security, maybe 200, 400 rupees, very small investment. And once you do that, it is a case study for you. So we look at how price moves, how price falls, and how the company changes. You keep reading the business dailies, and so taking track of doing the act. So this is one thing. Another important thing in education is most of these IPOs that come out, most of the offer documents that come out, most of the SEBI documents that come out, most of the RBI regulations come out, they are not directly discussed in classrooms. So we have to see that these are discussed. More than doing your trading, you can have dummy trades and you can have understanding of all these offer documents. When just by an IPO, bringing an IPO to the classroom, what I'm saying is that document. You can look at an IPO and teach what is a price band, what is ASBA, what is merchant banking, what is underwriting, by pinpointing the players, the date of opening and the date of closing. So we are dealing with real life situations. Same with SEBI, insurance and all those things. That will make it live. Today we are learning financial markets from books which are at least the earliest possible will be 2-3 years old. So bringing live cases of RBI, SEBI, insurance, mutual funds, company movements into the classroom is perhaps a practical approach that you can have.
Sir, there is a question. How will you comment the inverse relationship between growing GDP and downsizing GDP and growing markets?
Yeah. No, that I've already mentioned when I was talking about rationality. The thing is, when you have these macroeconomic factors like GDP, employment, and all those things coming down, when the indices were down at points, people thought that this is not long-term things which will stand long-term. So when they were at certain bottom levels, there was huge purchasing. And as far as India is concerned, many foreign nations, what I said FIIs, they have also looked at perhaps one of the fast recouping economies would be India. And that is why they also had pumped in money. This is what kept our capital market on the upper side or the reasonably good side. Both the FII players as well as the Indian institutional players who put in investments at the lower end, and they still see some promise for the economy in India. Any more questions?
Sir, one more question from Manu Anthony. Do you think the changed perspective of Indian middle class towards consumption expenditure is going to adversely affect our GDP growth?
Yes, the consumption patterns, as long as this pandemic continues, when it goes low, definitely the supply side has to go low. Say, for instance, hotels, airlines, transportation, tourism. When the consumption is blocked, obviously the supply and the delivery will block, and that creation also has to be blocked. You cannot go on creating more of these services when they are not being consumed. So, as long as consumption is not there, the industry will show its recession. That is quite obvious. But when it changes, you can have new opportunities. But it is very clear. So I just gave some examples. Hotel industry where you are saying consumptions have gone down, lockdown. Tourism sector where there is lockdown. Many things that you do, including your seminar that you're now doing, you're doing it in terms of online. So there is less transportation. There is less flying, airlines. Railways being put into lockdown. So consumptions are less, and those sectors definitely will get affected, and that will have its impact on the GDP.
Thank you for the patient listening of all participants, and also to our expert who has been the whole day was in the academic area and found time for us.
I was with interview throughout, so that's the
I told them, sir. I told. Yeah. Then that hectic work, a day-long work there was. After that, he joined us, and we should be extremely thankful to him for this. And I formally express this for all of you and for the departments. Thank you very much, Simon, sir.
Thank you.
And
thank
okay, thank you all participants.